are schmutz. Don't be put out, won't be too complicated. So what is a put option? Puts, simply put, are the opposite of a call. So everything a call could do, they can't do better. They do the opposite. A buyer of a put is entitled to sell shares at the strike price of that put anytime before the expiration date. A seller of a put is obligated to buy those shares for the strike price anytime before the expiration date. So why then are puts schmutz if calls aren't schmalls? Because puts are priced to sell. When you look at a stock and you go equidistant from it, let's say 10 points from the current at the money strike, and you look at the puts and calls, a lot of times you will find that the puts trade richer than the calls. This is because risk to the downside tends to be at a higher velocity. Things crash downwards. They don't generally crash upwards. In certain stocks like biotechs and in some things that have gone hyperbolic, you will see call skew, but most of the time the put skew means that they will trade fat. So they are priced to sell, so we sell them. Let's get back to houses. In the last example, Simon wanted to sell his house. We use this to discuss the call options and the kind of their relative place in trading rather than using the actual underlying. You can use a contract on it. So, it's called speculation in the industry. It's called options trading nowadays. This time, we're going to look at Tony and his house. This right here, that's Tony's house. Tony doesn't like the downside, though. Hey, you know what? I only like when things go up. I don't like when they go down. Nobody knows what kind of accent this is, but doesn't matter. I'm going to do it anyway. Tony's neighborhood is near the same shopping center that did not open as a Simon. If you'll remember, they were going to open a shopping center. There's going to be a super Best Buy. Everyone's going to be mega happy, right? Well, it didn't open. So the value of everything went up, and then it went crashing downwards, and everything ended up about the same. So let's kind of stick to that. The market's tanking right now. Tony wants to find a way to offset the loss in value to his house. He had just made the hundreds of thousands of dollars on papers. Oh my God, look, my house is worth so much money. Hey guys, you know how much my house is worth? He's telling everyone, hey, my house, yo. So he's talking about this stuff all the time. But now it's gone the other way. Market's tanking. He doesn't know what to do because he doesn't want to sell his house yet in case it goes back up. So instead, he's going to go to this guy, Bob. Fucking Bob's a degenerate gambler. This guy will take the other side of anything you want to do. He'll bet on a child's hockey game. Doesn't care. Bob is a great dude. So he tells Tony he's got a plan. He's like, Tony, I'm going to sell you insurance on the price of your house. Ho, buddy. Nobody's ever thought to do that before, huh? Ho, hey. And Tony's like, what? You would do that for me? He goes, yeah, buddy. I like you. What Tony's doing here is buying premium. It sounds awesome, doesn't it? It sounds like, oh, my house is worth more. I want to lock in what I got here. I don't want to lose my money. It sounds too good to be true almost, right? It is. Because Bob is the one making out like a fat cat here. He's selling a covered put. Actually, Bob's just selling a naked put in this case. I should change that. This right here, Tony's house, market value right now, $400,000. Oh my God, $400,000. It was $500,000 last year. What's going on? Cost basis of this place though, $325. I got a good deal, buddy. So Tony's sitting fat right now. He's got $725. Sorry. Excuse me. He's got $75,000 right now sitting in equity in his house. Okay? He's gonna pay Bob $15,000 for this insurance on the value of his house. Let's be very clear. For $15,000, Bob is on the hook for $400,000 if the price of the house goes well below that. Technically, he's on the hook for $385 because of the put premium. Anyway, what this does for Tony is obliterate his cost basis. Oh my God, you guys. $340,000. It just raised it by 15 because he paid put premium. So he paid a premium to buy insurance, basically. It's the sell that the street uses to get everyone buying puts. Bob, though, smart guy. Tony's looking at $60,000 here in sick gains. He did use it as an instrument to lock in $60,000 from his current value. He had 75 if he'd sold it now. He didn't want to sell it. He locked in 60,000 at least for the duration of this put. Puts have time value. We'll get into that later, but for right now, to make this simple, he paid 15,000. He locked in 60. All right, what happens here? If the price of Tony's house is 415,000 or more by the expiration of that option, let's say it's a year, Bob gets to make money because there's no reason Tony would sell his house to Bob for the 400,000 if his house is worth more than that plus the money he paid for it. Because technically his basis is 340, he doesn't want to lose the money on the 400, so he's looking for 415 or more, okay? If the price of Tony's house is less than 415,000, actually if it's less than 385,000, Tony makes money because the further below 385,000 it is, the more money Bob's on the hook for that Tony's not losing in value. That house could go to zero tomorrow because it gets blown up in a crack fire or something, and Bob's on the hook for all that money. The thing here is the likelihood of a crack fire randomly blowing up your $400,000 house in Arizona or whatever isn't that great. The likelihood of nothing happening and Bob collecting that 15,000 sweet cash and doing nothing and not having to buy a house is much higher. You will see that when you look at probabilities. So Bob wants to do this because, man, most of the time, he's just going to collect that money. He's going to collect that premium. He's going to put it in the bank. He's going to have a good day. Why would Tony want to do this? Tony wants to do this because he's already up on the house. And he bought the line that, oh, you hold the house forever and it always goes up. Yo, hey, it always goes up. So since he bought that, he's buying puts. He's wasting money in a dumpster fire because he loves the way burning money smells to, quote, protect his asset. In a house, this would make more sense than stock because houses are highly illiquid compared to Apple or the spiders. So what do we do with this? What's our takeaway from all this crap? Puts are an asset that exists to be sold. When you sell a put, what Bob did is he got long Tony's house without having a house. Tony came along and Bob had no exposure and goes, hey, I'm going to take $15,000 for you, and if your house goes up in value, I just make $15,000. He bet Tony's house would be the same value or more and got paid to do it. Tony paid him money to make a bet his house would be worth wildly less. Do you see here how Tony has one way to win and Bob's got three? He can have the price of the house move less than the premium. He can have the price move none and trade sideways. He can have the price go to infinity and he collects that $15,000 or a little bit less. But as long as he makes a profit, he had nothing before. He didn't have to put up $400,000. He just got paid to take that risk over time. It's leverage. It's always leverage, baby. That's why you sell puts. That's why you sell call spreads. That's why you sell calls. Options are priced to expire worthless, so you just sell the crap out of them with high probabilities. You protect yourself with deltas, and we're going to teach you all that. It's going to be fucking magical. Institutional traders for years, okay, have treated volatility since 2009, let's say, as an asset class that exists to be sold, so to speak, without actually knowing how to do it. Many of them are shorting call spreads. I'll never forget, I believe it was Bloomberg. I'll never forget what this guy did. This guy at Bloomberg came out on Wednesday, August 16th. Could have been the 17th. It was right before that 24th Monday. He came out with, I'm looking right here at a risk reversal selling 3 front month VIX calls and buying 1 back month VIX call. Hey, I'll sell volatility the front month and buy one in the back, and it'll protect me. The next day, the VIX spiked like $5. The Friday after that, it went up another. The Monday after that, we crashed, and the VIX was 52. That guy was out of business by the middle of the day Friday. On Monday morning, they were taking his corpse out and working to bury him, okay? He didn't get to see the rally. That institutional nonsense of getting short front month volatility is crazy when you can sell options to do the same damn thing. You can sell puts and sell calls to short volatility. You want a short volatility? You sell puts, you sell calls, and as volatility gets crushed, when a stock goes back up, when a market goes back up, when a commodity goes down, premium comes out, you buy your shit back for cheaper, and you make money. Put skew just gives you a better shot at that because they're priced to be sold. That's why puts are schmutz. So in summary, puts are a bullish strategy. Selling them gets you long an asset without having to be fully exposed to the capital required to hold it. Selling puts profits when the underlying moves higher, stays where it is, or drops. When you buy them, it's a bearish strategy. You think things are going to go down a lot. There's only one way to win, and that is when the underlying price goes lower. The whole point is, compared to an equity, a put gives you margin relief. If you want to get bearish, you buy a put. It gives you a margin relief because you don't have to put up all the capital to short the stock. You want to get long a stock, you sell a put. You can get a bunch more credit than you do selling calls or buying calls. It's just a great capital efficient return on high return on capital way to get long a stock, get long an equity, get long a market is to sell a put. You don't have to put up $100,000 for stock. You put up $1,000 to sell a couple options. Thanks for listening. This has been another Intro to Options series with Ferk Polo. If you have any questions, please send me an email, ferkpolo@me.com. I'll be happy to get back to you. Next time we'll be covering spreads and slightly more complicated discussions of options, puts, calls, and we're going to actually use stock the whole time.